Welcome, dear viewers, to this inaugural session of our YouTube series being held from 10th to 16th of October as part of the World Investor Week. Hermay Talks is bringing this session to you live in collaboration with our partner, BSC Investor Protection Fund. World Investor Week, an initiative by the International Organization of Securities Commission, is a global investor awareness campaign that witnesses a host of investor awareness activities. In India, it's conducted under the auspices of the market regulator SEBI. And as a part of this, Hermay Talks, in collaboration with BSC Investor Protection Fund, has put together a series of fireside chats with industry leaders, financial literacy sessions, and the like. Today, I am pleased to introduce you to our speaker for the day, Ms. Swati Kulkarni, Executive Vice President and Fund Manager Equity at UTI AMC Limited. She holds a Master's in Financial Management from Narsi Monji Institute of Management Studies from the University of Mumbai. She also holds a CFA Charter conferred by CFA Institute, USA. She is also a Certified Associate of Indian Institute of Bankers, CAIIB, UTI. Swati has a long professional experience and has been with UTI AMC for the last 24 years. He was recognized as being among the top 3 of India's best fund managers in equity category by Outlook Money in 2010. So welcome, Swati.
Thank you, Hemant. Thanks for inviting me today.
Let's dive straight into the topic. I'm sure Swati has a lot of insights for all our viewers, all our community members at Hermay Talks. The topic at hand. Now today, it's no secret that there are prevalent fears of an impending recession, a global slowdown. In fact, the IMF chief, Kristalina Georgieva, has stated that expectations of a world recession are strengthening, and global growth has been downgraded to 3.2% this year, which is 2022, and further down to 2.9% for 2023. So the global output loss expected till 2026, or the next 4 to 5 years, is expected to be around $4 trillion. So how real is the expectation of a global recession by this year end or early next year? That's part one of my question. And the part 2 is what kind of recovery will it be later? A V shape or a W shape, or is it too early to talk about recovery? So in a sense, what would be our overall sense of this whole recession fear?
Sure, Hemant. I think in terms of the technical aspect of recession, consecuting 2 quarters, if the economy shrinks, that is likely to be a recession. But when you look at actual data which is coming till, I think, July, August, the data was quite positive, whether it is in terms of and I'm talking about US particularly. So whether it is in terms of the retail sales growth or in terms of the unemployment rate, all these data was pointing towards a much robust picture. Now, therefore, when it comes to the interest rate action from the Fed side, that is likely to be strong, hawkish for a longer time, and that is really creating a kind of a fear in the minds of the equity investors that perhaps, like for earlier we were talking about the terminal rate, Fed rate being 3.75%. Now already people have started to talk that it will go beyond 4% because the inflation becomes a priority and growth is a sort of that's not so much of a worry for the central bankers today. So in a way, there is also a belief that the excesses that were, they were released because of the pandemic, probably in terms of actual money going to in the hands of the people when, the typically earlier QEs were within the financial circle, like this time it was central banks giving money to the government and government actually giving back to the people. That has kind of had resulted initial impact on the inflation because the goods demand certainly went up, whereas the supply was disrupted. But so the initial transitionary phase that the markets were expecting for the inflation, and the central banks have talked about it in their policy documents about the transitionary nature, that seem to have become much more stubborn. And therefore, the efforts to bring this inflation back would come with strong interest rate action. And therefore, the recession fears are definitely there. It's not that the recession, we can't just wish away the recession, because growth is a second priority, at least for the now. So that's the first part of your question. Fears are definitely there. The second part, whether it is V shape or W shape, this reminds me of discussions just in March 2020, when all of us were hit by the COVID as a new, nobody had the back book to really depend on, and therefore the discussions about whether it will be a long path to the recovery or whether it will be a quick recovery. The history now we know with the hindsight mirror that it was a V-shaped recovery as far as at least the stock markets world over were concerned. That was probably driven by the liquidity. But coming to the data specific, justification for this is basically we have seen in past, like in US data, again, because US has a lot of data, and this is, I'm quoting from CLSA Global Strategy Report, that whenever the inflation, the core inflation peaks, the returns after that for equity markets have been positive in excess of about 14% or so in past many instances where this inflation has peaked. So that is one way to look at it. And there are, of course, various lead indicators like PMIs, which is released by ISM data. If that particularly is hovering around 50 to 53 at this point of time, and in past such recessionary periods, this data has gone down to as low as 40 or 42. That also has been a good lead indicator if you happen to invest in equity markets when these data are at a trough. The returns post that about for a year have been quite good, in excess of 25%. But all these are a matter for people who are actually well invested in equity, and for these intellectual debates otherwise do not matter if we are quite low on equity investment. And again, these are market specific trends. India certainly is a different market at this point of time, and I'm sure we'll discuss as we move ahead.
Sure, and I think you hit upon a very relevant note when you talked about the central bank's current penchant for hiking interest rates. We have been seeing the US Fed doing that. We have been seeing the RBI also doing that with the repo rate. I think we had a 0.5 percentage increase last month. And in fact, the RBI governor has been on record, Mr. Shaktikanta Das, saying that they are very confident of taming inflation in terms of a rate hike mechanism. So that brings me to India, actually. When you talk about India, and the traditional sense has been that India has always been a kind of an insulated economy, so to speak, not that much impacted by global shocks or supply shocks, etc. So I want to talk a little bit about India. So while the RBI's GDP projections are hovering around 7%, the World Bank, in fact, has cut down the forecast to 6.5%. Right, their previous forecast was 7.5, so it's a full 100 bips down from their earlier forecast. And while we also talk about the rising effects of inflation, rising interest rates, and the possibility of lower exports due to slowing global growth. Keeping all this in mind, coming back to my initial point on this particular topic, that India seems to be a little bit insulated from global recessionary shocks or supply shocks. So how do you see this unfolding? Is this, when we talk of India as an insulated market, relatively speaking, is this kind of a buy signal for investors, in the sense that global growth is slowing? So international investors as an economy, they would try to probably focus on India as one of the major markets for investment. So we may expect some FII inflows, in which case the Indian bourses stock markets could probably see a surge. Is that how we can look at it? Is this a buy signal for Indian?
So I think there are too many points that you address in your question. So, for example, first of all, I don't think India is an insulated. We are part of the same world, and we are definitely not decoupled. Though the recent performances are suggesting that India is definitely having a much positive trend and outperforming most of the markets. But having said that, you also mentioned about the exports, being not good given the global situation. They are not likely to recover also. So therefore, there will be some impact on our growth also. But coming to the specific points about, FII inflows, or in terms of why India has outperformed, that there could be a, points there in terms of, when it comes to the global geopolitical situation, India has shown that there is an autonomy as far as the policy decisions are concerned. We have also seen that the earnings growth has been superior compared to others. We have seen our return on equity improving, and therefore, from December 2020, if you see the MSCI India performance, that is clearly showing that we are up by about 30% from the levels of December 20, whereas other emerging market MSCI indices, or China for that matter, are actually have seen a destruction of value from the levels of December 2020. Having said that, I think when it comes to whether buy signal or not, or that discussion, I would say that first of all, the tightening by US is clearly moving flows away from the emerging markets to the developed markets, that is US particularly, and that will continue as long as Fed actions or interest rate tightening will continue. As far as the Fed pausing the interest rate increases, that is the time when your dollar index is also likely to soften, and you could see flows coming back to various markets. In that situation, I think India, being the positives of India in terms of growing much better than the other markets, having domestic demand potential, having much lower external debt to GDP ratios, and having policy autonomy as far as the overall geopolitical risk assessment is concerned. I think these are some of the points which will again have a long-term interest of these FIs whenever that situation improves in terms of, risk-on situation could come. Meantime, for a buy signal or a sell signal, I would say that fundamentally we should look at valuation. So for example, for the broader market indices, if you see last 10 years range for price to earning multiple has been 16 to 24 times. Today at 22 times reported earnings, we are just about 10% above the average. We are not yet crossed that 24, which is a red line, so to say, one standard deviation above the average. And therefore, I would say that one should link these valuations to the one's asset allocation rather than getting scared by what the global recession fears are, or in terms of whether India could decouple, or whether there could be a major setback to Indian economy or Indian stock market. So I would say that we need to really look at inward to have our own asset allocation, because we have seen, despite these narratives which have been there for time to time, last 1 year itself, you would have seen these narratives moving from, let's say, the lockdowns to, again, we have RBI raising rates. Then we had geopolitical tensions, and today we are talking about recession. So despite all these narratives, we have seen that equity as an asset class over a long period of time has been giving returns which are inflation beating. And therefore, I think it's better to look at from that perspective. If you are too much invested in equity today, definitely, like let's say if you are above 60%, your allocation of savings is into equity. The current levels are actually a level where you could want to slow down or go in a staggered way. But if you are, let's say, 10-20% only invested in equity, each correction in the market is a good opportunity to allocate more into equity assets, I would say.
I will before I move on to the next question, Swati, I just want a quick thought in terms of we know because of the Ukraine crisis, India has kind of restructured its oil purchase. I think from a level of maybe 1% of all purchases, we have moved up to, if I'm not mistaken, around 11 to 12% today. So this definitely would have some, and it's at a discounted rate. So this definitely would have some impact on the inflationary trends we are seeing in the Indian market today. So a quick thought on that vis-a-vis demand that we are talking about, and vis-a-vis investor appetite for, let's say, more investment because of
Yeah,
surplus.
so yeah, definitely there is a positive effect of that, I would say. But fuel as a part of the basket, that again has a limited weight. So from that perspective, I would say that the getting into winter season typically, where fruits and vegetables, which is also a good part of our basket, their prices will soften, and therefore I think for us, for an central bank or RBI basically, the inflation control in India would be a far manageable task, I would say, than what perhaps the other economies are facing. One is that the other economies have never seen these kind of levels, and therefore to bring back to a much lower level is a big task. I would say that India has shown earlier that how CPI was brought down from 8 to 9% to as low as 4%. So I think these positives, as you discussed, are definitely there. And typically in an environment when global slow, the commodity prices are not likely to stay high for a long. But as you know, oil is perhaps that supply side arrangements could lead to oil prices remaining high, and therefore that will have a bearing. But at the margin, I would say that these positives are having a smaller impact on our inflation. And inflation is not so much of a worry as far as Indian economy is concerned. We have good amount of expertise in dealing with these, and I think last 7-8 years we have successfully shown that inflation is the prime motive of the central banks, and we have delivered on that.
Those are very reassuring words coming from you, Swati, for our viewers, definitely. When we talk of global recession or the impending recession, so to speak, and let's say India is caught up as a hypothetical scenario, is caught up to an extent that is more than normal, let's say, right? So we are talking of a scenario where we are not that well insulated, so to speak. And maybe recessionary waves hit us, and we are part of that. In such a case, what do you think? How do you think the bourses will react? The stock exchanges, how much will they swing? Are recessionary fears already factored into current stock prices, right? And I want to kind of compare this with what happened at the start of the pandemic. I think we saw a huge dip in March or late March, where the stock exchange, the Sensex lost around, I think, 30 to 35%, straight from 41K to, I think, 26K, around 26, 27K. But it equally rebounded equally quickly, right? It was not that kind of a protracted kind of a downswing, or you could say the recovery was much faster than. It wasn't even a recession, so to speak, at that point, whereas the fears were there just when the pandemic hit. I just want to compare with that, and we are maybe not in a similar situation, but in terms of what one expects, a common investor kind of sees recession being thrown around everywhere, right? And then those fears or uncertainties are built up in the mind. So maybe a few words from you in terms of how the stock markets may react, or have they already factored in these fears? Have the stock prices already have factored in these fears in that sense? And are we seeing any kind of support levels in the indexes today?
So, Hemant, actually, I will just give you some background about how we look at companies or businesses. So, rather than their movement in the stock prices, if you link it to the businesses, then it will be easier to understand for your viewers, because typically if you look at the companies which have been in the businesses for many years, they have the strong balance sheets, or the good managements to back these businesses. Typically the economic these ups and downs, they are well trained to kind of look at these challenging phases, and their balance sheets are also able to support that. And therefore, like in pandemic time also, when we see that the markets bounce back, it's the effect that many companies have actually managed these periods, and leading companies have in fact resulted into market share gains. So when you value businesses, typically you look beyond these short-term, gyrations that could be there in the economy and the business cycles. And typically, when we value businesses, we are looking at the future cash flows, which the current pressures or the recessionary fears would affect the near-term cash flows by a small percentage. I'm not denying that, but when you are looking at a company as a going concern, and you are looking at an aggregation of a company, like you mentioned about Sensex has the top 30 businesses in terms of market capitalization. When you look at such aggregated cohort, and you are looking at companies which are going valued on a going concern basis with the cash flows that they keep generating for many years to come, I think one need not be worried about these values getting disrupted over a period of time. And therefore, I would say that it is very difficult for us to predict that how much of it is priced in, and whether there could be further correction or not in the short term. In fact, that's not the part of our fundamental style of investing in equity markets. Basically the retail investors' money, and therefore we will not be able to call out that. But our experience suggests that these times are actually very good if the investor control their behavioral biases, that is the fear psychosis. If they control and maybe stagger their investment, definitely it's a good time to kind of accumulate your investments into equity. I'm not saying today, but as I said again, I'm repeating, the corrections could be good way to look at increasing your allocation into equity markets.
Yeah, that's a very good point, Swati. In fact, that brings me to my next question. In fact, so the question that's probably haunting investors, the retail investor today, would be that how do I play this now? Because if I'm looking at 2-3 months down the line, there could be a slowdown, and if I'm expecting stock prices to fall. Now, the first part of my question is specifically investors with lesser exposure to the stock markets, to equity markets, or maybe newbies to the market who have zero or nil exposure or minimum nominal exposure to the equity markets. How do they look at this kind of a scenario? Do they is it kind of time for them to start buying the lows, right? So is that something they can do? And once I'll let you answer that, and maybe after that I'll come to the second part of my question.
Yeah, so I would suggest that, for investors who are very low on equity, actually, first of all, the SIP is the best way for mutual fund investments in terms of averaging out. So even if the market goes down, for the same amount that you put monthly, you get higher number of units. So I think that is a classic, or must have for all of us. The SIP is a good way to build your savings and generate wealth over a long period of time. Maybe asset allocation that fits into the person's risk appetite and the ability to save. From that perspective, each person would have a unique asset allocation or a customized asset allocation. And it's better to look at your asset allocation and have exposure to, again, for example, we are talking about the GSEC, 10-year GSEC at 7.5%. Now, if you invest at those levels in the debt also, your current income or current yield is also quite good. So probably you could, and if whenever the market or the interest rates start to come down, there could be an benefit on that aspect also. So there is a merit in allocating to equity as well as to high quality debt. And short-term needs we need to keep, as in liquid funds. So I would say that for the people who don't have equity allocation, one is that it is a must that you start SIP and you increase the SIP amount as your income levels go up. So keep the same proportion that you can allocate today. And also because it's important to have allocation to different asset classes, I think that's also can't be ignored. Yeah.
Definitely. And the counterpart to that question, or the second part of my question is, so the other side of the spectrum, which is investors with higher exposure to equity or maybe more than average exposure to equity. What kind of steps would you recommend they take right now in the same context of an impending recession?
So I would say that, as I was talking to you, that 24 is the upward 24 times price to earning multiple on the reported earnings is what we have seen in the last 10 years as the upward level of the valuation. Today we are at 22 times. So I think if the markets go up further, we could look at, for the people who already have higher allocation to equity, probably could, readjust to their desired allocations. For example, let's say a person who has 50% as an equity allocation for him is desired, and the markets have given that return of 30% over last 5 years, and that allocation has gone to, let's say, 75%. These are the times you correct back to maybe 50% or so. Incidentally, our multi-asset fund is run based on the quantitative way of asset allocation. That is suggesting the 50% allocation for that particular fund. So I would say that valuations can be a guardrail to adjust your allocation, and discipline is very important to come back to the level which is good for you. And typically, if you have a long horizon, let's say 5 years or 10 years, that's another aspect which you can inbuild, that, over the 5 to 10 years, these fears or whatever economic cycles we are talking about would have got evened out. So that's another aspect which some people who may not want to take any action, and just if their risk appetite permits them to ignore these noises, that is also an important, I would say, solution for those who can afford to take those decisions.
All right. Very sage advice on that. So coming to, we have talked about equity now. All the equity as the direct as well as mutual fund kind of equity exposure. Now coming to the non-equity classes. For example, if you take commodities which are traded, gold or silver, or if you take real estate, even if it's physical real estate or through mutual funds and REITs, more on the mutual fund front, or if you take, let's say, debt asset classes. How do we look at these asset classes in the say, what approach can an investor take? While we talk about equity, how can we talk about the non-equity part of it in the same way?
I would personally think that the real estate, physical real estate particularly, actually is, it has its own disadvantages, I would say, because there is no market transparency. And it is always, my experience has been that it is a seller's market. It is basically when you go to buy or you go to sell, it is very difficult. Illiquidity could be an issue there. And typically, when we look at real estate, we are willing to give a long period, like at least 10 years. You don't typically take and trade in real estate for 1 or 2 years. So you have to have that kind of time frame if you're really looking at into real estate. The second thing, of course, is that the maintenance part of it and things like that. I would say that over a 15-year period, again, equity has beaten real estate as an asset class. At this point of time, with a full understanding that you want to kind of give that kind of period of holding, maybe real estate in a good well built or developed real estate is something which you could look at. But I'm not in a camp. In fact, I would be a hardcore equity oriented investor. So I'm little skeptical about looking at real estate as an investment part. In fact, it's good to have your own house, but not from a perspective of investment. As far as gold is concerned, typically when there is a lot of uncertainty, gold is seen to be doing well. For Indian investor, it is also, gold gives an exposure to currency also, because gold prices are determined in US dollars, and therefore whenever there is the translation of it into Indian rupee, you're actually playing on currency movements also. At this point of time, I think whenever there is a heightened activity as far as the geopolitical situation is concerned, there could be a shift towards gold, and therefore some allocation to gold is fine. Maybe about 10% of your allocation to gold should be fine. Debt, as I mentioned, typically debt funds, the duration funds, you should look when the interest rates are likely to, I would say that likely to go on the top. That is the time when you should look at me. So maybe around 8-ish of 8%, if at all that goes 10 year, that is a time when you should be far more constructive on debt. At this point of time, I would, if you ask between debt and equity, probably high, quality debt, that is a GSEC and AAA, that is probably looking attractive versus the equity investments.
Sure. I just want to touch upon a couple of quick things. When you mentioned that, there has been a slight, a nascent interest in, let's say, for example, floating rate debt. So, what are quick thoughts on that? And second part is, you have almost answered my next question, which was what kind of asset classes would one avoid? By you already talked about the real estate on its physical form. I would like your thoughts on real estate in the mutual fund form.
Yeah, so actually, as far as floating rate investments, I may not be an expert on this, but my personal opinion on the floating rate is, when the interest rates are topping, that is the time you should be actually looking at more of a, as I said, that go for duration and the fixed rate funds. As far as our own fund house, we are looking at this current periods, we are looking at encouraging on the accrual products, and also look at the reducing maturity kind of that those kind of products. As far as the mutual fund real estate funds are concerned, probably that could be a better option, because you have exposure to income generating properties or real estates also in that, and there could be a much steadier way of looking at real estate as a sector rather than individual property investments, I would say.
Point taken, Swati. But let me kind of add on to that, in the sense the entire real estate industry in India has been seeing some kind of a soft phase or a dull phase, as you would know, for the last number of years. So, barring a few select real estate houses, most of the industry is in the doldrums. New demand is not picking up. There's a lot of inventory, unsold inventory, etc. So, the entire sector is in some kind of a distress. Like I said, apart from some pockets of, let's say, better opportunity in terms of select real estate houses. So when you go to a real estate mutual fund, which probably buys into different, I think there's a minimum of 30% in terms of physical infrastructure that you have to buy in, if I'm not mistaken, when you try to construct a mutual fund. So given that the almost entire sector is in some kind of distress, would someone look at the real estate MF also with the same trepidation, with the same uncertainty, with the same apprehension, as one
Sorry, then
part of
actually,
the
Hemant, I
digital
understood you were asking REITs. I was talking about REITs earlier. That
rates.
is,
Yeah, I'm talking about, yeah,
so
mutual fund part.
that no, I was actually talking about REITs. So REITs basically, because there are underlying, income generating properties. I was talking about that. But what I now understand is you're looking at a real estate fund in terms of investing in real estate. I would say that it's a very risky bet because being a concentrated bet in investing in this. I typically sector bet should be avoided, or sector bet should be kept to about minimum of 5%. All put together, different sectors, the exposure could be about 15% is what we think. And real estate, certainly, as you mentioned, while there has been I would say that the negatives that you just discussed about, the sector being under pressure in terms of the regulatory requirements which came in form of RERA, and in terms of the NBFC funding drying up. So those definitely those issues were there for the sector. But I would also mention that the disclosure levels and the governance standards have also gone up. And when it comes to mutual funds, you have that advantage of selecting companies based on certain these fundamentals that they would look for. And instead of buying on their own direct equity, that could be a little bit fundamentally strong approach to buy through a mutual funds. But again, since it is a concentrated bet, limited to about 5% maximum.
I agree, Swati. So maybe the consensus would be that not only limiting your, in the sense, your as in the investors' allocation to real estate through mutual funds. Maybe they could also look at the different the objectives of different mutual funds in terms of what is that mutual fund trying to achieve, so that they get a
Yeah,
sense of
and the process behind selection of
process
stocks.
behind selection. Yes. So given all this, I think that's a good kind of view that the investor can take on this, especially the real estate mutual funds. Uh, as we come to the close of this integrating opening session of our talk series, in the context of this topic, any words of advice, Swati, for our newbie investors and for our women investors?
I would say that we have seen a trend of youngsters looking at equity markets from a perspective of trading or quick gains. My experience has been that you make the most when you actually give time to reap the fruits of your investments, and therefore limit your direct trading or direct equity exposure to maybe about 10 to 20% of your overall savings, because simply because you may not have time to review your investments and go through in detail about selecting stocks. You may have the intelligence, but typically you may not have the time, and therefore I would say to restrict that. Given the current scenario that we discussed, it's better to stagger your investments, and better to manage your fear by at least allocating some amount when the market corrects, not to run away from the markets. These discussions about recessions have been there for last at least 3-4 months. It's not that this is something which is totally unheard of. And instead of predicting the market movements, it's better to stay prepared in terms of what you invest in. So select good process-oriented certain funds, and have allocation to various asset classes as per your requirement and your financial objectives, cash flow needs. I think that would sum up the overall investment experience that I have had.
Okay, that's good, solid advice coming from Ms. Swati Kulkarni. These are very wonderful insights. I totally enjoyed talking to you, Swati, and it's a real pleasure having you over.
Thank you, Hemant. Thanks once again.
I'm sure our viewers, our community members would have found these insights and advice very valuable in their informing their investment opinions and thoughts. To all our viewers who are watching, thank you for joining us. in this inaugural session of the YouTube series by Harmony Talks and BSc Investor Protection Fund. Thank you.
Thank you.